Accounting, a systematic way of recording and reporting financial transactions for a business or organization. Owner, proprietor. A proprietor is an individual who owns a business establishment or sole proprietorship. This person has legal use of the assets and their operations. Capital, a financial asset or the value of a financial asset, such as cash or goods. Basically, the money or assets an organization can put to work or anything that owner invested in business. Drawings will always subtracted from the capital. Drawings. A drawing is an accounting record maintained to track money or any other assets withdrawn from a business by its owners for personal use. Accounts receivable, debtors, the amount of money owed by customers or clients to a business after goods or services have been delivered and or used. Accounts payable, creditors, the amount of money a company owes creditors, suppliers, etc., in return for goods and or services they have delivered. Credit. When using the double entry accounting method, there will be two recorded entries for every transaction, a credit and a debit. Credit is an accounting entry that may either decrease assets or increase liabilities and equity on the company's balance sheet, depending on the transaction. Debit, an accounting entry where there is either an increase in assets or a decrease in liabilities on a company's balance sheet. Balance sheet, a financial report that summarizes a company's assets, what it owns, liabilities, what it owes, and owner or shareholder equity at a given time. Profit and loss statement, P&L, a financial statement that is used to summarize a company's performance and financial position by reviewing revenues, costs and expenses during a specific period of time, such as quarterly or annually. Trial balance, a business document in which all ledgers are compiled into debit and credit columns. Cash flow, the revenue or expense expected to be generated through business activities, sales, manufacturing, etc., over a period of time. Liability, it is something a company owes. Assets, it is something a company owns which has future economic value. Depreciation, the monetary value of an asset decreases over time due to use, wear and tear or obsolescence. This decrease is measured as depreciation. Income. Income is money that an individual or business receives in exchange for providing a good or service or through investing capital. Expense. Expenses are amounts of money that you spend while doing something in the course of your work. Outstanding expense. Outstanding expenses are those expenses which have been incurred during the current accounting period and are due to be paid, however, the payment is not made. Prepaid expense. Prepaid expenses are future expenses that have been paid in advance. Ledger. Classification of similar transactions under a particular head is known as ledger. Ledger is an accounting head, which is used to enter a transaction and also to identify the same in the reports. An asset is any resource owned by the business. Anything tangible or intangible that can be owned or controlled to produce value and that is held by a company to produce positive economic value is an asset. Simply stated, assets represent value of ownership that can be converted into cash. Types of assets: current assets, fixed assets. Fixed assets are two types: tangible assets and intangible assets. Examples: cash, inventory, investments, pay, property, plant, and equipment. Land, buildings, vehicles, furniture, patents, stock, etc. Current assets. Current assets are assets that can be easily converted into cash and cash equivalents, typically within a year. Current assets are also termed liquid assets, and examples of such are cash, short-term deposits, stock, office supplies, accounts receivable. Fixed or non-current assets. Non-current assets are assets that cannot be easily and readily converted into cash and cash equivalents. Non-current assets are also termed fixed assets, long-term assets, or hard assets. Examples of non-current or fixed assets include land, building, machinery, equipment, patents, trademarks. Tangible assets. Tangible assets are assets that have a physical existence, we can touch, feel, and see. Examples of tangible assets include land, building, machinery, equipment, cash, office supplies, stock. Intangible assets. Intangible assets are assets that do not have a physical existence, we cannot touch, feel, and see. Examples of intangible assets include goodwill, patents, brand, copyrights, trademarks, permits. A liability is a debt owed from one company to a person or company that is not an owner of business. A liability may be a part of past transaction done by the firm, e.g. purchase of a fixed asset or current asset. The settlement of a liability is expected to result in an outflow of funds from the business. In totality, total liabilities are always equal to the total assets. Capital plus liabilities equals assets, so liabilities equals assets, capital. Current liabilities obligations which are payable within 12 months or within the operating cycle of a business are known as current liabilities. They are short-term liabilities usually arisen out of business activities. Examples of current liabilities are trade creditors, bills payable, outstanding expenses, bank overdraft. Non-current or fixed liabilities. Second among types of liabilities is non-current or fixed liabilities. They are long-term obligations of a business and are not payable within a year or an accounting period. They are generally used for the purchase of fixed assets. For example, long-term loans, bonds payable, debentures. Owners' funds, capital, equity. Last among types of liabilities is the amount owed to proprietors as capital. It is also called as owner's equity or equity. It is an internal liability of the business and includes reserves and profits. Accounting equation: owner's equity equals assets minus liabilities. An expense or expenditure is an outflow of money to another person or group to pay for an item or service. For a tenant, rent is an expense. For students or parents, tuition is an expense. Buying food, clothing, furniture or an automobile is often referred to as an expense. Types of expenses: direct expenses and indirect expenses. Expenses connected with purchases of goods are known as direct expenses. Companies that manufacture their own products will assign the costs of materials to direct expenses. This will affect the costing of the products sold. For example, purchase price of goods, freight, wages on goods, insurance of goods in transit, custom duty, factory expense. Indirect expenses are the costs incurred in the daily operation of a business. Simply, all expenses other than direct expenses are assumed as indirect expenses. Such expenses have no relationship with purchase of goods. For example, salaries, rent, printing charges, legal charges, insurance of building, depreciation, office expense. Income is money that an individual or business receives in exchange for providing a good or service or through investing capital. Income is used to fund day-to-day expenditures. Types of income: direct and indirect income. Direct incomes are the incomes generated directly through business-related activities. For example, sale of goods that you produce or for the sale of services that you provide. Example, salary, sales revenue. Indirect income is one which is earned by way of non-business activities. Indirect income are those incomes that you generate from other activities which are not linked directly with your main business. For example, sale of old newspapers, sale of carton boxes, interest received from bank, rent received. Journal is the first book of original entry in which all transactions are recorded event-wise and date-wise and presents a historical record of all monetary transactions chronologically. It may further be divided into sub-journals as well, which are also known subsidiary books. Journal. Classification of accounts, types of accounts, traditional approach. Here are a few important things to know and understand. Now we will learn the golden rule. For personal account, receiver is the debit and giver is the credit. For real account, debit what comes in and credit what goes out. For nominal account, expenses and losses are debit and incomes and gains are credit. Now let's take some examples of some journal entries to understand how to record the transactions. Thank you for watching.